there's this concept of realized and unrealized gains, and unrealized and unrealized losses. So a lot of times, what people are looking at is losses they haven't really had yet, and what they're also looking at are gains they haven't really gotten yet.
Yep.
And they're making a lot of times decisions on that, they're making decisions thinking they've already taken those losses and thinking they've already made those gains.
Welcome to This is Financial Intelligence, the podcast not about the glamour of money, but instead the vulnerable and real conversations that we're all afraid to have. Brought to you by Money Club. What's up, everybody? I'm here with Ope Thomas. Ope has been a good friend for like probably 5 years now, and he and I have had many conversations, probably too many dialogues about way too many subjects, but today we're getting hyper-focused. Ope has been teaching, so Ope's got a really awesome background, but aside from his app development and information systems, like just prowess, he also has been helping other people understand stocks and investments. And there's a lot of financial intelligence involved there because there's so much behavior. So I'm really excited, man. Thank you for showing up, and we're excited to talk to you.
Yeah, and thank you, and thanks for inviting me and having me. I'm happy to talk about this subject that I'm passionate about.
It's going to be wild, man. Let's start. I think in for so many people, right, the stock market is it's intimidating. And if you're listening in, this isn't just going to be like talk about stocks as stocks in the market, but we've got to, let's layer this cake a little bit. How would you describe the stock market to like a 5-year-old, right? How would you break it down super simple so that someone listening is like, oh yeah, I get that.
Yeah, it's a marketplace. You walk through a bazaar. Let's say you're on vacation somewhere and you're just walking through one of the street vendors that sell food, and you can imagine that everything that they're selling, they're getting from suppliers. So you as a customer, you're walking through there and you just want to buy some food, and then you look behind those counters for a moment, you realize these are all individual businesses. And I really just describe it as a marketplace where these businesses are trading with each other and also selling to customers. And as the customer there, you're trying to figure out where you can get the best price for what good that you're purchasing for the food. So you have, want to take that analogy a little further. Let's say you just want to buy a dish of some street meat or fried bananas or something, and you're in Jamaica.
I love fried bananas.
Right, and you find different prices for them, and you're just trying to see, okay, where is my money going to go the furthest? Where can I get the best price? And that's a good place to start thinking about what the stock market is.
I love that. In a lot of ways, growing up, the stock market was off the table. Like we didn't talk about the stock market until I got to college and I was studying the market, right? But it got really complicated really quickly. There were like derivatives, puts, shorts, calls. Right now I'm like, what is happening? There's derivatives that we're now trying to understand and explore and like do the math on. And then you look at the graphs, and the graphs are complicated. As an adult who has been helping people understand, where to get started and what it means to get started, let's stay away from like the tactics of you got to buy the good, because I think that metaphor is really helpful. But thematically, what's it mean to buy a stock, and what does it mean for us to make the decision to go into the market?
Yeah, and so when you're walking through this marketplace, you have two choices. You can either buy the food that the vendor is selling, or you can buy a piece of the vendor's business. So let's say that dish that you're going to buy for them is worth $10. You can say, hey, I will buy $10 worth of your next shipment of spices, and for that, we can work on an arrangement, and I'll get a piece of that revenue of what that portion is worth. That's what you're doing when you're investing. You're buying a piece of a business. and it could be any kind of business. And it can get kind of heady where it's like businesses that are just funds of businesses, where they're combinations of businesses that you're not investing in one company, you're investing in a fund of businesses. So I say that's where those are places where it can it's not you're not really dealing with singular entities, and it can get a little more complicated, and it can scare people off. But really, it's just simply you're as an individual, even outside of thinking of the marketplace, just as an individual inside of an economy, you have two choices of what you can do with your money. You can either consume or you can produce, essentially. And there are other thoughts. So when you're consuming, you're again buying that product. You're subscribing to Netflix. You're buying Chipotle sandwiches. And when you're producing, you're investing in Chipotle and you're investing in Netflix. So you are buying, when you're in the stock market, you are buying a piece of a business, a piece of a company.
Well said, man. In many ways, one thing that I experience when I look at stocks and even consider investing is this concept of return, right? So in any conversation, investing is all about, what do you get back? How much is this going to grow? When do I get my money back? Right? Those are dialogues I think we're probably all very familiar with. What gets interesting though is to change the timeline that we're evaluating that answer. So if you're saying, well, what's the return in a month versus what's the return in a year versus a decade versus a century, we have an entirely different landscape. How do you feel that time changes the way that we have our mindset attached to returns?
That is a great question, because it forces me to give a very thorough answer, and then it allows for the opportunity for people to think about the stock market in a very clear way.
Let's do it.
Yeah. And the things I believe it was from the book Capital. I believe the Capital in the 21st Century. I forget that, but it's a popular book. It's a couple 100-page book. I haven't read the whole thing, but there are parts of it where they talk about capital, money, and because also capital is not just money, right? And there's different things. But one thing that we want to realize is that we call currency for a reason, because it's current. It's something that's flowing. So when you're thinking about money or capital, there's different things. There's assets, which maybe they're not flowing currency, but they have value. But when you're talking about how much a dollar is worth, you're talking about currency. And so you're talking about something that is flowing like a current, like water. So part of understanding the stock market, part of understanding risk reward and time frames is realizing the stock market as a current, as a stream that's flowing, a current in it. And you as an investor are trying to tap into parts of those currents and create bigger channels for yourself and so on. But it's really a current, and understanding that will help. You can then start to understand the impact of things such as inflation. So what people don't realize, and why I think it's important to learn how to invest yourself and do DIY investing, is that whether or not you buy a stock, you're always investing because of currency, because currency causes inflation and deflation. So the market, the value of a dollar is always fluctuating anyway, whether you invest in something or don't. For the most part, it's fluctuating against people that have the dollar, because the value of the dollar is decreasing, which is why you always hear, oh, this such and such used to cost this many dollars and now it costs this many dollars, which is always some crazy amount. And if you have that same dollar, that means that dollar is also worth a whole lot less. But if you invested, you have an opportunity to not only keep your money current with the current value, but you have an opportunity to earn more. to essentially tap into those streams and tap and create those channels. And that I think is why I really appreciate that question, because it really touches on the understanding of the stock market before you start to say, okay, what do I go buy? But really understanding that what you're doing is recognizing that money is a currency and it's flowing, and invest, and whether or not you are making investment decisions, you're always investing, because currency causes inflation and deflation.
So I love this metaphor of the current. I think there's a lot that we could unpack here that could be really fascinating. So as a business owner, we also use the term like cash flow, right? Very similar theory in that money is always moving through a business, not just to a business. I also think in this conversation of stocks, the idea of a current allows us to look at, I'm like drawing a picture while I do this, but what's happening upstream and how that affects downstream, right? So I really love where this is going. And we're flying by the seat of our pants here as we make this metaphor. But if we're looking at a change in the upstream, naturally we can expect a change in the downstream. And that's really the piece of time that matters, right? If a company makes a change in their business in a report that reflects a change in their business, or leadership, right? All kinds of things can happen upstream. There's obvious ripples that happen in that current, as all things do. But how do we as normal land walking people, how do we figure out, these things happened upstream? What does that mean? Is the current going to diminish? Is it going to expand? What are some simple ways that we can look at, okay, I think this happened upstream, or I know this happened upstream. Here's a prediction. And maybe even before we get there, maybe we should talk about the fact that this is all on prediction. I don't know. Where do you want to start with that?
Yeah, this is why one thing I always say is that the stock market is not a casino, and it's not a place to go and gamble. You are really making educated guesses. So it's the difference between, let's say, a scientist and a philosopher. A philosopher is essentially imagining, and they're thinking, and and a lot of times you can take that philosophy and turn it into science, right? And then the science is what's actually tangible, and that's what then I guess can have actual value that can be traded. Now, in that analogy, relating it to the information you're getting from the stock market and from what's happening upstream, is to look at it as a science, and to say that and to really take the emotion out of it, and to take as much of the guesswork out of it. So to understand as much of the science as you possibly can, which is why, and the science can be deconstructed into many places, such as understanding the industry, understanding how stocks work, just those basics, understanding the actual business or the product. So the science is different. So you understand, okay, if they're bringing in, I'll take a great way to learn as example, right? So you have a management decision that's being made where, but there's a management decision being made, and let's say they're bringing in a new vice president, and they have two decisions. They want to either bring in someone from the business currently, and is that good? Okay,
still good.
So they want to bring in someone from the business who understands the business already, and that can have one impact. They have someone who they want to bring in that is completely from a different industry. Now, one thing about understanding the science is just asking yourself, what might this mean? And let's say, I'll try to make this example quick, actually, because it could get really long, but you bring in someone from the inside because they understand the industry, so they can kind of grow with when things are similar to what they've been, let's say. And you may bring in someone from a different industry when you want to innovate your industry and have things to think differently. Now that may be good or bad depending on the timing. So as an investor, you may look at, okay, why did they make that decision to either, whichever one it is, doesn't really matter, but let's say they brought someone from the outside. Why did they bring that person in? And is it the right timing for that business? Let's say they brought someone raising vice president from internally. Why do they do that? And is it the right time? And then that will get you to kind of like think about the competition of that business. So that question you're asking is, it's difficult to look at one piece of information and really understand what the downstream effect is. But what's really cool is that, like a current, it follows a pattern, and something that follows a pattern can become a science. So when you see certain things happen in management or in the market or in the industry or in the technology or what have you, that's where the investor needs to be, they need to be real with themselves about what is it that they understand. Do they understand management, the sciences of management practice? Do they understand the sciences of technology? Do they understand the sciences of supply chain? And that's where the DIY comes in. That's, you can usually outsource a lot of this to a broker, an advisor, and they'll just follow somewhat of a portfolio theory where they'll balance your portfolio with different risks. But when you're doing it, when someone's doing it themselves, when you're doing it yourself or DIY, or even trying to just do part of it, learn is that you want to take your own personal experience, because you may not have access to all the research and teams. So you want to hedge your bets a little bit by taking your own experience and saying, okay, what do I know? So where can I reduce the risks of the investment? Because no particular investment is a bad investment. It's just a matter of what's the risk associated with that investment. Because it could be good for one investor at a certain time and bad for another at another time. And it's just really, again, about what's the risk associated with that investment. I think that's what matters. So looking at those changes in management or in product or in market and seeing how they affect the downstream is understanding the science of the business and being a little bit existential or looking internally, understanding what do you understand and what can you learn, because you can learn anything. So what sciences can you learn that relate to the businesses that you're interested in investing in?
So let's do a little highlight reel, because that was flipping awesome. So a big one here, just thematically, is that the stock market should not be seen as gambling. I think there's this belief that we're betting on, an IPO, we're betting on some of these different tactics that take place. But I love the idea of focusing on education and getting more educated as a means to select our risk and our risky maneuvers. Gambling in general is based on outcomes we can't predict, right? You play poker, you're gambling, you're hoping that the 7 turns over so you win the hand, but you have very little influence on that. While you potentially don't have influence on the stocks, you can definitely read the patterns and I think get a little bit more information than you may on a roulette table, et cetera. The other element that I loved was this breakdown of philosophy and science, right? And there's an interesting pendulum swing between these, right? Philosophy may inform science, and science gives way to new philosophies, and it kind of goes back and forth. But the idea that in separate pillars, the philosophy is based on our own opinions and experiences, where the science is rooted in the data, the realities, and the events. So I love that. Then you said the magic words for us here, right? If this is all about, this is financial intelligence, that's the name of this podcast, then you said the magic words, take the emotion out of it, right? We've seen, so we're recording this end of May in this COVID experience. We've seen 2 dramatically different experiences. So when this all happened, we saw emotional fire sale, and it was just pew. And then after, I don't know, maybe 6 or 7 weeks, we started to see an emotional uptick in everything's back. here we go. And we're kind of doing this again. So I really just want to highlight for anybody listening, the emotional part of the stock market is by far the biggest winner and loser for most people. It may bring you these like super high highs, but it will also bring you these super low lows. And somewhat it depends on your goals, right? Opie, if you know, an individual is 55 and the stock market tanks, there's a very different reality for them than if we're, you know, in our 30s. Nonetheless, the emotional decisions are really, really dangerous. Then you said another magic word for us, patterns, right? Thinking about patterns and reading into the patterns. So 1, 2, 3, that's four gems, man, 4 gems. If I could like throw coins to you, I would. So let's dive a little deeper on the emotional part of stocks, because I think that's where a lot of fear of getting involved is one of those emotions. But even inside of it, right, there's all this triggering of pressures around us: buy, sell, do it. You know, is it worth it? It's risky. It's seen as gambling. There's just a lot of emotions that are tied with it. How can a person that's on the outside of the market looking in learn to cool their emotions and make better choices?
Yeah, I think that the concept of philosophy and science is very, very important to lead with, because where many people make a mistake is they try to jump right into the science, or they try to just learn the technique. Oh, if it's going up, let me buy. If it's going down, let me sell. And that's just very rudimentary, like surface level understanding. And that's without understanding the philosophy, because the stock market, in my opinion, I'm saying this is factual, written anywhere, but I believe that it's the science of human emotion. Yep. on a mass scale. So you're essentially betting on human emotions. Yep. If a company is doing well, you're betting that the value is going to go up because more people are going to see the value in that company and buy more stocks. If the company is losing money, you're going to believe that it's going to, the company probably lose value because less people want to own the stock. But where those are clear, but they're also very simple. Where it can get kind of tricky is when maybe they're losing money, but the stock is going up. Or maybe they're making money, but the stock is going down. So again, you have to look at human emotion. Why is that? For example, Apple's a great example. So I worked as a stockbroker, and worked. I saw Bitcoin at $20. I actually sold it to some clients at $20.
No.
Yeah, but we weren't actually allowed to buy the stocks we were selling because of the interest at the time. But saw some crazy investments. But Netflix at just like $80 or $60, something like that. And where was I? Oh yeah, so but Apple's a great example because there was a time when Apple was just their revenue was just skyrocketing. People were saying they're going to be $1 trillion company, but then there were quarters where their stock would go down like 3%, 5%, 10% in a day. But what was happening was that analysts were expecting them to do much better than what they were doing, but they were already doing really great. So it's like the actual value of the company was so much higher than where the stock price was because they weren't meeting analyst expectations.
Interesting.
Some people were just making bets, and then some people were betting on the bets, and then there's the company's actual value. So it's really just understanding how these different interactions play with each other. And it's very hard to understand that without understanding the philosophy of the stock market, how human emotions work, and just looking at the technical and thinking that I can just read a chart and I can just listen to somebody who's smart, but not really understanding the human emotions of it and how that works. Because as much as people try to remove the emotions, it's always in there, and the stock market is simply a reflection of that. And even as a company increases with fundamentals alone, meaning that people aren't just buying on news, or it's not just inflated buys or inflated value, that's still somewhat of an emotional increase, but it's based on fundamental facts. Like it's based on actual sales, it's based on an actual function in business, and not just based on news, or not just based on a lot of people buying. And then that's when you see things tank, and you see weird things happen with the chart because people are buying on emotions or selling on emotion, like what you were talking about with doing what we saw a few months ago during the COVID crisis, and still seeing now. And what's happening now is that people aren't really sure what's gonna do well. So when you see where there's a lot of opportunity for, if you can learn it, is like just like some day trading or options trading, where some companies are just gonna shoot up temporarily simply because people are panic buying. They want to just buy something that's safe. So once something seems like it has, like once a company says we have enough cash on the books, or a company says, we saw sales increase this quarter, you're going to see a bigger buy than you would normally see, simply because people are trying to look for somewhere safe to put their money.
Mm-hmm.
And that's an opportunity to go look at that company and say, okay, are they really worth the value right now? Or, should I wait? And if they are, then you're like, oh, okay, let me keep buying. Like Zoom's a great example. Some people may have missed that uptick, but it went on for about 2 months. So, if you saw it happen in the first couple of weeks, you could have said, oh, okay, this is a good opportunity maybe to, people are panic buying, but it's a smart panic buy. And then there are other ones that, people are panic buying, and then 2 weeks later it tanks. So that's where the research really comes into place. And I'm not even sure if the original question, I'm hoping I'm answering it. But
no, you've done a great job, man.
But that understanding that philosophy, and understanding that the stock market is the science of human emotion, and the more you can remove your emotion out of it, the less you get caught up in the market,
mm-hmm.
and the more you can see it clearly. But you have to understand the philosophies around investing as well as the science of it. And that philosophy is about how human emotions work on a macro scale.
I love this. So we've magically added more to our original model, right? So if we have this current, a stream, we can now dive a little bit deeper. I've made this awesome image of like taking the emotion out, betting on human emotion, and then finding patterns and how information is kind of all in the middle of that. So I want to bring this back for anybody listening. If we look back at the idea of upstream, downstream, and we have a decision or information that comes out upstream, we have the ripple effect of that actual information, right? The science of that information.
Right.
This is what that's going to do for that business. Maybe they decrease their prices, or maybe they got lower supply costs. They can now increase their profit margin. This seems great. But then you have the human emotion layered on top of that, the philosophy that is, well, I think that, and this must mean that, and oh my God, this is a great opportunity. Or sort of the converse of that, which is this must be calamity in the marketplace, and immediately setting into something like panic. Panic buying is a very interesting word too, because that is a hugely emotional word, right? Panic is not a simple emotion like I'm happy or I'm sad. It is a full-fledged, like your emotions are on level 11 out of 10.
They're making the decision.
Totally. And I love that we've come back to this. So the gem in this one was that the market is simply a reflection of our emotions, right? I think in many ways we have been looking for ways to model out the stock market, right? To look at if this happens, then this happens for the entire existence of the market. And yet we look at the market as if it's this mathematical equation, and the one X factor in all of this is we're humans, and we do weird stuff, right? We do things that are illogical. We do things that break patterns. So I love that we've come there. Let's go one layer deeper and add more to this model. We've got upstream, we've got downstream, we've got emotions that change the way the information is viewed, but we've also got the very natural response when we make a decision. So let's talk about that for a minute. So let's say we get the information, we see what's happening, we read it, we then make a choice. What's interesting about humans is, and I find this fascinating, even about myself, is that when we make a choice, we have emotions about the choice that we made, right? So not only do we have emotions to make the decision, but then we have emotions that we made the decision. And that
I wish
may
we
or
called
may
other investors.
so we may like avalanche our own choices and be like, oh, that was a terrible choice, or hey, that was a great choice, I'm going to make another one, right? Sort of like our hands are hot or our hands are cold. How have you seen that type of thing in the marketplace or experienced that? I have, but I'm curious if you have.
I mean, that's gonna happen. That's a given. I mean, you're only human. We're all only human, and I think everyone has to make those mistakes, and everyone continues to make those mistakes. And I think part of the maturity has been to combat those errors. And the stock market gives you tools to do that. You have limit buys, you have stop losses, you have different tools to use at your disposal to remove the emotion out of it. And this really, so it really comes back to the initial point of understanding your risk tolerance, understanding your time frames, and that can help you craft a plan and a strategy before, even if you give your money to a broker or a banker or anyone else to manage it, they're going to ask you those questions. What's your time frame for investments? What's your risk tolerance? And they're going to use that information to create a plan. And what that plan does is it gives you the opportunity to remove the emotion. It gives you the opportunity to follow the plan and not follow the emotion. It doesn't mean you're going to do that 100%. Mistakes happen. And even if you give your money to broke, mistakes happen in the sense that you might just feel like you really want to buy this company, or you might get really scared and you might call your broker and like sell all of it. And at the end of the day, you have that control. And that does trip a lot of people up, but you're better off if you can create a plan. And now the next thing about creating the plan is to stick with the plan. And that, that's where, one thing that I've learned and I've started to embody is that the trade happens in the research. So if you're seeing something right then and there, best good rule of thumb is don't buy it, don't sell it. And unless you know why, like you really know why. And that can be a vague direction. But what I would say is, if you haven't done the research beforehand to know why you're selling it other than it's going down, or why you're buying it other than it's going up, then you already kind of missed the opportunity to make the right decision. So half of the investing is really done in the research. So you should know that if it hits this price, I'm gonna sell regardless of how I feel. If it hits this price, I'm gonna buy regardless of how I feel. You should have already known that before the stock got to a certain price or made a certain move. And that's a really important step. So really, I think what a person can learn, and you really learn this by losing a lot of money and making a lot of those. You're like, all right, it's not working to just to just look at some information and figure it out and say, okay, I'm gonna buy with it. You really have to have a plan. Like, okay, how much am I distributing to this kind of risk? I'm going to only put 10% of my portfolio to options. I'm only going to put 50% of my portfolio to high risk or high growth technology stocks. I'm only going to put, you stay within those parameters. And then then you drill deeper, I'm only going to take a 30% loss. Even if I think it's going to go up, if I hit 30% loss on this investment, I have to get out of it. I'm going to take a 40% gain. Even if I think it's going to go up further, if it hits 40% gains, I got to get out of it. Or maybe I sell 75% of it, keep a little bit, let it kind of increase the upside. And that also comes to your time frame, right? If you're trying to do maybe invest within shorter time frames, own stocks for a couple of weeks or a couple of months, you have one strategy. If you're looking to really build positions, create funds, I suggest you have both. I suggest you have value funds that you're creating, that you're investing over long periods of time in companies that are going to grow, like you've seen Apple, Netflix, and all these companies in the last 10 years grow, and also have accounts that are maybe a little less than that you're investing in short, holding stocks for shorter periods of time. And I suggest both, but we can get into those too. But the important point there is just to have a plan. and whatever that plan is, to follow the plan. And once you do that, you don't have, that you can recognize the emotions when they come in. Sometimes your emotions are right and sometimes the emotions are wrong. That's not really the important part. Well, but what's important is, okay, what's the plan? And if you feel emotional, just ask, are the emotions matching the plan? And if they're not, then just look at the plan and make sure you're doing your research.
I feel like this is just good life advice, right? Like, make the plan. When it goes awry, ask yourself, is this part of the plan or am I way off course? So a couple more highlights here. You got anything you want to add?
Yeah, there is one thing. So because there's this concept of realized and unrealized gains, and unrealized losses. So a lot of times what people are looking at is losses they haven't really had yet. And what they're also looking at are gains they haven't really gotten yet.
Yep.
And they're making a lot of times decisions on that, they're making decisions thinking they've already taken those losses and thinking they've already made those gains. And why that's important is that you could expect a stock to go down 50%, depending on what kind of stock it is, but you think it's going to go up 200%. Now, these are obviously, I'm describing a very high risk strategy or high risk investment. Again, it's not a bad investment, just high risk. So you could expect that. So if the stock is going down 30%, you shouldn't be afraid. You should have that expectation, because that's part of investing in the strategy you're taking on to invest in that stock. So you're really worried about what are going to be your realized losses and gains. Now, if you expect the stock to only go down 10%, and maybe you have an opportunity to earn 25%, but then the stock goes down 30%, now that's something where you can be like, okay, well, I should probably sell. I've lost too much on this investment. You follow what I mean? Where it's really about there's really an importance to understand what's the realized gains, unrealized gains, and know what you can expect before you invest in the company.
So let me simplify that for somebody listening. There was a point where you were talking about where to put the portfolio, and whenever I hear someone go really deep into those spaces, I remember having like a stinking feeling in our chest. So I want to simplify things for a couple of people. One, if you don't have a plan, there's lots of people that can help you make one. And you can always get help, right? What we're talking about here is if you're acting independently and making some of the choices with your own money without support of an advisor or an investment manager, this is some theories and some ways to look at balancing your risk, right? All those different categories are all about managing your risk so that if everything goes awesome, you do great. If everything goes poorly, you're not nearly as damaged. But I also want to simplify realized and unrealized gains and losses. This is a huge thing, right? Imagine you've put in $100 to we'll call it an Apple mouse, right? So this mouse is now, I've paid $100 for it. If it's now selling on eBay for $90, it would be an unrealized loss because I haven't yet sold the mouse for $90. If I sell the mouse for $90, now I've lost 10, right? That's the only time we realize we experience a loss. So when the market tips, everyone's like, oh, I've lost a whole lot of money. We haven't realized the losses yet. It's only expressed in a sale. And to your point, this is where we can get really tripped up and emotional, even more so than before. When we see a portfolio that goes from X to now a much lower X, we say, wow, I've lost a lot of money. But unless we sell, we'll never realize that loss. Same thing with gains, right? If we don't sell it, even though the stock price is higher, it's just theoretical. So it's a really good point you brought up. The other piece that I want to hone in on just before we wrap this up is this idea of learning through our mistakes and developing maturity. So I made this awesome, like sort of like bubble graph of learning through mistakes and maturity being linked. And I ended up drawing kind of a circle through this. We learn through our mistakes, we develop a little bit of maturity, then we go back to practice, get some more experience, learn from those mistakes, and develop a greater sense of maturity. And the reason that's so important is that our market awareness in news, in social media is like, it's like being in the market is a talent that you were born with. And it really is a practice. Investors are old and wise because they have experience. They've gotten burned, they've gotten damaged, they've taken the blows and then become good. And if you ever want to get into something, golf, soccer, programming, Call of Duty, whatever it is, you're probably going to start really bad at it. And Opie, I think you did a great job of nailing, developing market maturity through our mistakes rather than around our mistakes, right? It's a critical piece of this.
Yeah, and that trading, getting that investing plan is the best step someone can make in getting started. Learning about as much as you can and making a plan and doing the best to stick with it. I was checking my phone because I wanted this. There was a lot of stocks that had this V-shaped curve, which were just highlighting your point about or re-highlighting the highlight you were making about realized and unrealized gains, where so many people had unrealized losses during that time. And a lot of these companies, Snapchat was a great example because I owned some of it. It tanked, I think 50 or 60%. And then in a month, it went a little bit above where it was. Now, people who held on to it would not have seen any losses. They might see some unrealized gains now, just 2 months after the tank. People who sold, which were many people who sold during that time, actually saw realized losses. So they're the ones who actually lost. And there was just so many examples of that. And during just a short period of time, because of the pandemic and lockdowns and all the stuff that are being experienced that are affecting the market, you're seeing that interplay of realized and unrealized gains and losses. Yeah, so that's an important point too.
Love it, man. I absolutely love it. So let's wrap this up clean. You've dropped a lot of gems, a lot of wisdoms. There have been so many different takeaways, man. I've got a full list of like pictures and graphs and charts and new ideas to meander through. Where can someone find you if they want to learn more or reach out to you?
Yeah, so my course on Skillshare, Navigating Wall Street Waters, I think that talk a lot about this. I'll be launching a website soon and called DIY Investing Today, where I'll be giving free DIY tips and putting out more educational content around DIY investing. And so look out for that, and always find me on social media. So look forward to connecting with more people. And thank you, Aaron, for this opportunity and to share this knowledge.
Dude, thank you so much for being here. Thank you guys for tuning in, and we'll see you on the next one.